Alright, so in this video I'm going to go through how to invest in 2024 and basically how to retire in 2024. I'm going to go through a little bit of everything in this video. So basically grab a pen, grab a pencil, write a bunch of stuff down. I'm going to go through everything. So, who am I? I'm Nick. I was a financial advisor for many years, and basically I invented these products to turn the average investor or average person into an investor. You know, basically it's not too hard to invest. Don't let anyone tell you it's hard. I'm going to go through a very simple portfolio, you know, just for free. You don't even have to download my apps, and they're going to help you leave your financial advisor. Why do you want to do this? Basically, it's going to save you thousands of dollars in fees. So I have a few designations. They're behind me. You know, a CSC, CPH, WME, an economics degree, an LLQP. So I'd say I'm very well versed. And why I built these products, basically, everyone in the end is almost trying to do the same thing. Yes, you might have a little bit different risk tolerance. Some people might the NASDAQ. Some people might like a value fund. But essentially, asset allocation is your only main concern. How do you build a portfolio based on your risk tolerance? It's basically based on your age. I mean, the older you get, the less risky your portfolio should be, because you're going to run into a sequence of returns risk. Basically, if the stock market loses too many years in a row, which we haven't seen in a long time, your portfolio is going to erode too quickly, and that's why we add fixed income into a portfolio. So, what am I trying to accomplish? Basically, turn anyone in the world into an advisor. Basically, the only difference between you and a financial advisor is retirement planning software. I have the cheapest, most stripped down version of a retirement planning software available on the iPhone currently. Basically, anyone can turn their income into a pension. All you need to do is develop a retirement income stream, and that's what a calculator is doing. Now, basically, why you want to do this? The easiest answer is there's two types of people on the internet giving you advice. There's financial advisors saying, hey, we use financial planning software, but we're not going to tell you what we're invested in. And then there's other YouTubers saying, hey, let's live off dividends, but I don't have a clue what a retirement planning software is. So it's based on total return. Basically, that's what you should only be worried about. I get it. Dividends are nice. They pay you. But really, you're just buying a value fund that's going to be less risky than a growth fund. Alright, so let's jump over to Portfolio Visualizer and look at a Canadian and an American portfolio. Basically, this will beat a financial advisor. I'm going to show you a 60-40 portfolio. We're actually going to put 10% in cash, you know, a kind of a 3-bucket strategy. Your stocks, your bonds, and your cash. Basically, if there's a really bad downturn, like we just saw, you know, you can sell out of cash in your retirement. So anyways, basically how to build the simplest portfolio is we're going to put 60% in XWD, we're going to put 30% in HAF, and we're going to put 10% in PSA. To build a simple American portfolio, we're going to build it with IOO. This is the 100 Global Index ETF. Basically, it's the biggest 100 companies. You know, maybe a little less boring than VT, and it has a lot better historical performance as well. We're going to use BNTW. This is Vanguard's World Index Bond ETF. Basically, why we want to use this is it's the simplest way to spread your money around the world with fixed income. We're going to use USFR for our cash in America. This is a floating rate treasury fund. Basically, it's the closest thing to cash that's going to perform a little bit better than BIL. Now for the benchmark, I chose XBAL. Basically, we're trying to compare a 60-40. Now technically, these two portfolios, in my opinion, are safer. Basically, you're more diversified and your money is in cash. You know, it's a place to sell from in those giant downturns. And what we can see is these two portfolios outperformed XBAL. Basically, XBAL outperforms every financial advisor. In the long term, why? Just because of fees. You're getting charged 1% for someone to manage your money. And if you're not doing like a retirement checkup or moving your money once a year, you are not taking care of your money properly. I mean, your financial advisor isn't. So I'm giving you the tools to manage your money better than a financial advisor. I mean, you can manage your money. It will take you about an hour every month if you want to rebalance every month to manage your money better than any financial advisor at a bank. So for these 60-40 portfolios, like they're not bad performance. We're seeing 9 and 11%. Like this is a 60-40. Like this is a safer portfolio. You're not going to have a lot of standard deviation with these. Alright, so basically the only difference between you and a financial advisor is retirement planning software. Basically all it's doing is turning your money into a pension. You know, it's helping you run out of money the year you pass away. That's how you pay the least amount of income tax. That's how you save thousands of dollars and make a larger inheritance. You know, instead of leaving everything on your deathbed like so many Canadians do, it's going to get taxed a lot. Your property, your accounts, especially your RRSPs or RIFs at an old age, like basically these get taxed at full income. You don't want to do that. So, you know, once a year, basically, give a better Christmas gift. I mean, it's better to do that. You're going to help out the younger generation that especially needs help these days. There. I am not tracking your data. I'm not going to sell it to a large firm. Basically, this is probably the main reason why the app costs money. Alright, so this is what the calculator looks like when you open it up, and we're just going to go through this quickly. You know, how does someone use the calculator while saving for retirement? Alright, so let's say you're 30, you're going to retire at 60, you're going to live till 90. Right now you only have, let's say, $25,000 and you're saving $500 monthly, and let's say your returns are 9.51. And you're going to go with a 3% inflation. Now, what the calculator is telling you is, hey, when you're 60, you're probably going to have $1.2 million. And what you're also going to have is, that's going to pay you $8,000 a month in retirement. Now, this is your before tax number. So this can help anyone in the world. You know, I don't know what tax bill you're going to pay, but you just pay it. This is how you turn your money into a pension and spread out your taxes evenly. Now, this is a withdrawal rate of 7.67%. Why? You're getting pretty good returns. I mean, basically, you're hopefully going to lessen the risk of your portfolio because you're going to run into that sequence of return risk. But basically, this is just what the withdrawal rate is. If you're getting these high of returns, it's going to tell you, hey, you're okay to pull out this amount of money. Now, what these numbers are up here, this is your in today's dollars. So it's going to adjust for inflation, you know, 3% for 30 years. You're only pulling out $3,300 a month in today's dollars. And all you have to ask yourself is that enough? If it's not, okay, maybe let's see what saving $550 a month is going to do. All right, I got an extra $100K and now we have $3,600. So is that enough? And this is showing you, you know, what am I pulling out in the last year of retirement? So that's a lot of money. We got to adjust for inflation. 60 years from now, $3,600 is worth 21 grand. I know it sounds crazy, but this is compound interest. All right, so let's take someone in retirement. Let's just say they're 62, still living till 90, and they have that $1 million mark. They hit $1 million in their retirement. You know, you're retired, you're not saving anymore, and at this point, your returns are, let's say, 7.21. Now, most retirement planning softwares use 2% number. Basically, I think the only reason why is you got to account for the advisor's 1%. If you were building a portfolio with that advisor fee and a 3% inflation, basically everyone's plan would just break. Like, you got to adjust for inflation so much in these fees. Like, it's just going to kill your account. Like, the average Canadian is paying at least $250,000 in fees if you have a comfortable retirement. Like, that's a lot of money. Now, to figure out how much we want to pull out every month in retirement, turn our money into a pension, click retire. So basically what we're seeing here is we got $1 million. Okay, we're going to pull out $5,700 a month. Now, I think it's easier, in my opinion, to, yes, pull it out annually. Times that number by 12. But what this number, why it's putting it out in a monthly, I mean, that's your budget. I mean, this isn't your after tax, but this is your budget. Like, you have to ask yourself, is that enough? Now, again, why these are the same, this is your money in today's dollars. You're retired. Okay, yeah, it's 57. These should be the same. And when you're only adjusting for inflation 2%, the last year of your retirement, you're going to be pulling out almost 10 grand. To quickly show you, let's just say inflation is 1.8. See how we're pulling out less money? You don't have to adjust for inflation as much. And you get to pull out more now. So, if you have a full pension, and let's say only $100,000, maybe $250,000 sitting on the side, putting an inflation number at 1% will front run your money if you would like to do that. Now, it's something I don't highly recommend, only if you have a large pension. but you can do this. I mean, it's really up to you. If you didn't save enough and you want to front run your retirement to make it work, I mean, you guess you got to do it. That's a solution. That's all a financial advisor is doing, is giving you solutions. Saying, hey, we got to delay retirement a year. Or, hey, you got to save more money. When you strip down retirement planning software, this is what it looks like. When advisors take you through their financial planning software, it's going to come out with two options. It's going to say, hey, you're not saving enough. They're going to ask you to save more money. Or it's going to say, hey, you have too much money. Now I want to sell you a whole life policy to cover that tax bill at the end of your life. Or just pull out your money like a pension. Here's the answer. All right, so now we're going to see what it looks like, using a real life example with investments I talked about earlier, how we pull out money in retirement. So we're going to use a back test again using Portfolio Visualizer. So we're going to use the numbers that we just saw on Retire MGM, find our withdrawal stream, for the annual returns we're getting, and we're going to see what the investments look like as they play over the years with you withdrawing, even during the recent downturn we've seen, COVID and 2022. So with this example, pulling out money for the last 5 years, we actually still have this same amount. And year by year, you're going to have different percentages for your annual returns, and the calculator's dynamic. Put in your new returns and it's going to tell you, should you pull out more, should you pull out less? When the stock market's great, it's going to tell you to pull out more, lock in those gains that you have. When the stock market's not doing too hot, basically it's going to say, hey, your returns are less where you can afford to pull out less money. It's always aiming you to have $0 predicting the year you pass away. The only difficult part of retirement planning is we don't know what year you're going to pass away. You making a financial plan, I will not make one with an age less than 85 years old. Basically, that's just not responsible. A really safe plan, we're going to plan out for someone living 95 years. But essentially, the longer you live, the less money we can pull out because we got to account for all those extra years of life. So you can see here, this Canadian group and American group of ETFs just did great. They outperformed the benchmark, and pulling out money little by little is all you have to do to turn your money into a pension. Living off dividends isn't going to work. You're either going to leave a giant tax bill on your deathbed, or you're going to have to eventually sell near the end of your life anyways, so why not just start selling now? Get the best total return, not focusing on dividends. All right, so Canadians, RetireCan. This retirement planning software was made just for you to help you find your after-tax number. Basically, this is probably more important than just a withdrawal stream, but again, you can just use the last calculator if you want to save money. All right, so we're just going to take a look at a retired individual quickly and just kind of see how we develop a retirement income stream. So this is what the calculator looks like when you open it up. We're going to say, hey, you're 62, you retired at 60, you're only predicted to live till 85. Maybe that's why you retired a little early. And we're going to go with the 2% inflation. Now, this person, is not going to use their tax-free savings account to fund their retirement. This is where they're stashing money, to leave an inheritance. This is the best place. So we're not using this as a withdrawal stream, so we're not going to use the calculator for this. Now, let's say, they got $1 million in their RRSP, and let's say they have another $200,000 in a group RRSP, a job that they just kind of worked before retirement. And that one is currently getting 6.2%. Basically, all you have to do now is click what province you live in, and it's going to design your retirement withdrawal stream based on the returns specific to the investments. I mean, this is more accurate than most retirement planning softwares out there. They're just going to give you one flat number for one account, and this is saying, hey, some accounts are taxed differently. It's probably better to have stocks in a tax-free. So here's exactly how much you should withdraw out of each account based on each account's investment performance. I mean, it only makes sense. So basically what this is saying is, based on the returns and how much money this person had in their account, they're going to pull out $5,800 out of their RRSP and $1,100 a month out of their group RRSP. This is just saying, hey, a double check. Hey, do you have $1,200? Yes, I do. Okay, and here's your after tax. Now, this person might have CPP, this and that. I do have a one-fits-all app, almost ready to go. This will have a monthly subscription though, but I'm in no rush to launch it. Why? I mean, the main reason would be because Canadians aren't willing to accept the fact that you should probably take your CPP at 70. It is the best way to not worry about, outliving your money. Basically, the government's going to give you more money if you live. Your account doesn't give you more money if you live an extra year. The government will. But anyways, we're going to just put in your CPP at, let's say this person's getting $1,000 right now and doesn't have a pension. Again, click the number. It's going to adjust your after-tax number. So this app I update, once a year. I did add the capital gains feature. I'll make a specific video just for that. It's a little tricky. Again, this is the only app that has this feature. I haven't seen a retirement planning software that says, hey, we need to sell this amount of capital gains, and if you're withdrawing it, here's that amount. I'm trying to make the best product for you. These are products that I wish I had as a financial advisor. This is the only information you need. Don't overwhelm yourself. You only have to worry about a few things. How much do I take out of each account, and where do I invest my money to not screw it up? Alright, so let's quickly take a look at InvestCan. Again, an app that does not track your information or sell it to other people, and this is exactly how you're going to beat a financial advisor and maybe get a few better returns. Now you're going to see some ETF recommendations very similar to the ones that I showed you, and by very similar I mean exact. Now you're going to notice right on this app exactly how to build the same 3 fun, simple portfolios. So right here we have XWD taking care of the equities. We have HAF taking care of your bonds. Now this is like your fixed income equity split. This is going to show up once you start calculating your portfolio. And here's PSA, your oldest long-term cash. This is your oldest long-term equity, all around the world spread, global product, your one-fits-all. It only invests in large developed countries. Now it skips the emerging markets. I get it. I'm telling you to invest in it over here. I like just India though. So this investment avoids the emerging markets, a place where most investors, even financial advisors, that would be the first place you don't put money. To turn your money into a pension style recommendation, what I'm going to need is your current age, when you want to retire, and your life expectancy and how much money you have. Basically, this is going to help me find out, okay, here's the baseline. What would I recommend the average person, how by the left and or right, split your money up. It's how is it not going to, fail? And this is what it does. Basically, your percentages here that are going to show up, these are going to change month by month. The app is trying to find the best risk-adjusted return. How to make the most amount of money in the safest way possible. Right here's your rebalance. It's going to tell you your to-do list. How much to sell out of each and how much to buy out of each. Now, let's just go through the app quickly. Let's just say we're a 55-year-old, going to retire at 65 with an 85 life expectancy, and let's say you have $500,000. Here's your weights. Basically it's telling you how much to buy in each one. This is your first time purchase. You're not rebalancing. You're basically, here's your to-do list. Buy all these. A little bit of the left or right. I like ZID, for example, over here. And also in the rebalancer, it is giving you the best 10-year, 5-year, 3-year, and 15-year annualized number. These ones right here on the left has your best 15 annualized number. This is the best ETF. This one right here, this column, this is your best 10-year annualized ETF. These are the best ETFs for that asset class. Do you want to buy the best? Do you want to not have a bias? Follow the algorithm. Well, the whole point of this app is turning someone who is absolutely, has no idea how to invest and turn them into a seasoned investor. These are the people I'm looking for. If you're one of those people who are like, I invest another way, blah, 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 I don't care. This is why the apps are separate. If you want to invest like me with the best risk-adjusted return, how I would treat clients in the past and make them the most amount of money now because I'm not charging an annualized fee, here you go. If you want to retire and create a withdrawal stream, you need that. I have the cheapest retirement planning calculators. Download them. This is the only difference between you and a financial advisor. Alright, now Invest USA, same idea. If you don't want to invest like me, that's great. But basically what this app is telling you to do is buying the best 15, 10, 5, and 3-year number. You can probably figure out which one has the best annualized number, but the most important thing, and I don't think everyone really understands this, your asset allocation makes up, I believe, 90% of your returns. It's getting the risk tolerance and spreading your money, diversifying it around the world, getting that right. And that's what this app's telling you. It's giving you the percentages of how much of each asset class to buy. I've done all the homework for you. I don't know what else to tell you. Now, something I quickly forgot to mention in the InvestCan app, which is also on this, there's the MGN button. If you want to click the Money Guy Now button, this is exactly the ETFs that I'm recommending one-on-one appointments. Basically, this is the ETF format. Now, there's no percentages on there. Basically, everyone's different. An older investor, I might put a little bit more value into their portfolio. A younger investor, I might put a little more growth. This app allows you to basically keep you within the guardrails. This is how much I should buy of each one, but everyone's risk tolerance is different. If you want a 50-50, it being value growth and create your own blend, perfect, even better, more diversification. It's whatever you're comfortable with, but this app is going to guide you to make more money than an advisor. You're not paying fees anymore. Basically, you're buying index funds. 90% of advisors don't beat index funds. Now, there's also buttons just to quickly build a portfolio if you don't want to invest, basically the pension way. A lot of people, even financial advisors will say this, they'll be 60-40 their entire retirement. If you want to click the 60-40 button and plan your money that way, no problem. By the time you're 80, I'd say maybe start clicking the 25-75 button. You want to keep your money a little bit invested in equity still. You don't want to have an interest rate risk. But yeah, I get it. You're old. You probably want your money a little safer in fixed income assets. That's all fixed income is. I don't want you to make the most amount of money recommending fixed income. I recommend fixed income so you don't run out of money. So for those of you with kids investing in an RESP, you can also take care of this account on your own as well. Why you want to invest in an RESP? Basically, the government's giving you 20% returns right off the bat. That's what the grant is. I don't have an investment that just magically pops 20% into your account, but that's why you invest in an RESP. They're helping you make the education savings for your kid a lot easier. Now, it's also the most difficult to do, believe it or not. You have the shortest time horizon to save, and you have the shortest time horizon to spend. So you actually have to manage your money a little different so you don't run out of money. Get rid of that sequence of return risk. So basically, what I made here is a little formula you put in the average age of your child, and it's going to build you a portfolio based on the risk. It's also going to help you sell when you need to pay for your school. It's going to tell you what to sell from when you're using the rebalancer. So let's just say your average age of your kids are 8 and you have $25,000 saved up so far. Amazing. We're using the app for the first time. We're actually saving $200 a month. We're trying to max out those grants, and we've been getting 7%. This is a new little feature I added. Thanks for all these emails. I'm trying to make the product for you. That's what the Money Guy Now is for. What product did I want? And now I'm building, what product did you want on top of what I wanted? So what this is doing, and why I added this little feature, it's just giving you, a little bit of a goal. It's saying, hey, if I keep doing this for 5 years, 25 grand's going to grow to almost 50,000. Okay, they're going to be 13. All right. It's just helping you save more money. And it's also going to help give you your bond cash split. Basically, cash has been a safe haven over bonds recently. Hopefully you didn't have too many Canadian government bonds. They absolutely got slaughtered. Now, what this app has done is says, hey, this is the best 15-year number, this top row. This is the best 10-year annualized number, this row. The best 5-year and the best 3-year. Now, to go through the unbiased, this is why this app kind of changed a bit. As much as people wanted unbiased, they also wanted guidance. That's what this is, narrowing it down. Any of these work. You can buy 2 of these, you can buy 3 of these, or 4 of these. It doesn't really matter. What I also added, in case you have a bias, what company you want to invest in, it's not going to make you more money. Basically, the average annual returns is. So who cares about whatever logo you're buying? But I've also included, all the managers in Canada and the product that they have, the best one that fits in that category. And this is all you have to do. This way I can help 2 million people instead of 200. Why? I'm teaching you how to click the buttons instead of me.